Good afternoon, this is Sean Golding with Golding & Golding here to discuss the basics of U.S. taxation of Australian superannuation. We had done a presentation a few years back. We felt like it was time to update it. We have a lot of clients from Australia that we work with. They have lots of questions about superannuation, so let's get to it. Superannuation, right, or super, it's common in countries such as Australia and New Zealand, but just focusing on Australia, it's a hybrid pension retirement, kind of like a 401k, kind of like Social Security, though it most accurately resembles pension. You have a separate account. You put the amount of money in it depending on how much you work. You can withdraw that money. You may be able to take lump sums in certain situations. You can have multiple supers from multiple employers, etc., etc. Typically, what happens is you are an Australian citizen or a resident of Australia and you have earned a significant amount of super, and now you are a U.S. person, whether you're a citizen or lawful permanent resident, even a foreign national who meets a substantial presence test residing in the United States, and trying to figure out what the tax rules are, right? Your super was being taxed in the growth phases, depending whether it's concessional or non-concessional, and now you're ready to get distributions or maybe not yet, and you're trying to figure out the tax implications. You've read lots of things online from different practitioners, and I'll explain to you at least how we do it here. Contributions, right? In general, unfortunately, contributions, even if they're pre-tax from your employer, are probably still taxable in the U.S. Let me give you an example. You make $100,000 and let's say 10% of that was going to go into your super pre-tax. With a 401k, for example, in the U.S., you don't get taxed on that, right? The contribution is made, and then down the line, hopefully when you're in a lower tax bracket, you get taxed at distribution at a reduced rate. Unfortunately, the Australia and U.S. tax treaty doesn't identify that like it does in the U.S.-UK tax treaty, for example, which basically says you can take the same deduction that you would take on like a 401k on a UK employment-born type of pension. That language is not in the Australia-U.S. tax treaty. That tax treaty is pretty outdated, hasn't been updated in a while, except for a protocol, I think, in 2001. So from a general standpoint, the contributions are going to be taxed even if you can subtract it on your Australia tax return from a U.S. tax perspective. Growth is a little bit different. Now, in general, growth is not taxable is the position we take here. Why? If you look at the, first of all, Australia is a treaty country. In countries where there's no treaty, like Singapore, for example, the CPF, Malaysia, EPF, there's no treaty that basically says about when to tax 401k equivalent, for example, right? But with the Australia-US tax treaty, I believe it's Article 18, subsection 4, it basically says that retirement, when it defines retirement, it explains it's when you're receiving distributions, whether it's death benefit, injury, or retirement. And so the idea is you're not receiving any of that money yet. And so should you really be taxed on the growth? Different people take different positions. I personally have not seen the IRS come back and say the growth should be taxable, although they could and probably have, other PLRs and stuff like that. But there's no hard and fast rule that says that the growth is taxable. So that's something to consider. Distributions. In general, distributions are taxable because you're receiving the income, right? If you live in the U.S., there's not much of a position you can take. If you're living overseas, you may want to try to claim treaty benefits. Maybe you want to be treated as a foreign person, or you take a position that the pension is a certain type of pension that shouldn't be taxed. Now, that's for private. For public superannuation, you work for a government agency, university, generally that's not taxable. If you look at Article 18, it refers to Article 19. Article 19 refers to remuneration, which includes pension. It's generally only taxed by the source country. And so if it's being taxed during the growth while it's in the superannuation, you don't get taxed at the distribution. So that's something to consider as well. If you're going to take certain positions regarding the tax, it's just important to note that generally you'll have to file certain forms like an 8833. You can't just, decide you're not going to pay tax on it, take a position that you don't have to do that. Again, for the most part, superannuation contributions are going to be taxable. The growth depends on the position you take. Distributions, usually, unless you're claiming certain treaty rights. If you're out of compliance for reporting the superannuation, either the tax, the income, contributions, reporting FBAR, FATCA, Form 8930, etc., there are a lot of programs available to safely get you into compliance. If you're willful, you do VDP, the Voluntary Disclosure Program. If you're non-willful, there are a lot more options available. There is the streamlined filing compliance procedures, delinquency procedures, and reasonable cause. We got a ton of free information available on our websites, sub-websites. You can always reach out, schedule a reduced fee initial consultation if you think it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.